Welcome back to another module of the Property Investment Series. In the previous modules, we have already explored why we need to invest as well as looking at the whole property investment game. Now let's explore two important parameters in property investment, which will be used to assess your real estate investment potential. There are two golden tickets to make money from real estate investments, which are expressed through rental yield and capital gains. Before investing in property, firstly, you need to understand the investment parameter. This investment parameter can be divided into two, which are rental yield and capital gains. The holy grail for property investors is pursuing an area that promises a high yield in terms of a large capital gain, a strong rental return, and low maintenance, as well as management expenses. First and foremost, let's focus on rental yield. A yield is a measurement of future income on investment. It is generally a measurement used by comparing how much cash an asset may produce annually as a percentage of the asset's market value. In the real estate context, yield can be referred to as the rental income of a particular asset, where this can be generated in two different ways, by calculating the gross rental yield or the net rental yield. When calculating gross yield, the following formula is applied. Gross yield equals annual rental divided by market value times 100. Example, property value, current market, $325,000. Rental income per month, $1,800. Gross yield equals $1,800 times 12 divided by 325,000 times 10. Your answer is 6.6% yield. Gross yields are more commonly used as it allows you to easily compare properties with different values and rental returns. It can be expressed as the percentage of the property's market value or purchase price. Make sure you compare apples with apples, but as the property market usually fluctuates in nature, it is best to calculate the yield using the market value. However, do bear in mind that gross yields only provide you with a percentage before necessary expenses. Installments, maintenance, and yearly assessment fees are deducted. Now let's move on to net yield. Net yield is calculated as follows. Net yield equals annual rental income minus annual expenses divided by property purchase price times 100. For example, the monthly rental income is $1,500. Monthly maintenance fees, $300. Property purchase is $200,000. Net yield equals $1,500 times 12 minus 300 times 12 divided by 200,000 times 100 equals a 7.2% yield. The calculation of net yield is especially useful in determining your financial capacity in property investment. It gives you a clearer picture on your current financial position and whether your investment is sustainable. Technically, net yield produces a better measure when assessing returns as expenses are accounted for. High gross rental yield does not necessarily mean that your rental return will also be high, as gross rental yield does not account for expenses.